Hi, I'm Olivia Albrecht, and I'm joined by my colleagues Scott Mather and Joachim Fels. And it's been a pretty exciting quarter so far. We've seen inflation pick up, we've seen a renewed focus on trade policy, and yet we've seen that the global growth story is fairly similar, and it's still a fairly benign story. In fact, this may be the best global growth in years, as the chart suggests. So Joachim, is our Goldilocks thesis still intact, or has this run out of steam?
Well, I would say Goldilocks is still alive and kicking. Growth is robust, inflation is modest around the world, and we think this will likely continue in the near term, at least for this year. Basically, there are three reasons for this. First of all, financial conditions, despite some recent volatility, are still very favorable. Second, growth is really globally synchronized, as we can also see here in this chart. So almost every major economy is chipping in. And then the third reason is that we get fiscal stimulus here in the US, but also in some other countries around the world. So if you take it together, I think it's a pretty good outlook for this year. In the US, we expect growth to be 2.5% this year, maybe even a little bit higher than that. Inflation moving up gradually towards the target. So near-term recession risks for this year are really, really low. Having said that, I think over the medium term, there are somewhat higher and rising recession risks that I think investors should be aware of.
So Goldilocks is still alive and kicking. Good to know. So on the next chart, just start by saying that the cyclical outlook was titled actually a question, not a statement this time around. The question being, is this the beginning of the end? And we took two sides to that response in the debate that we had at Forum. One was, is this the beginning of the end of the expansion that we've seen over the past several years? Or is this the end of low productivity growth and ultimately the new neutral? Scott, maybe you want to take the first side of the question and answer, is this the end of the expansion era?
Well, it could be. That's the reason we brought it up. I mean, this is obviously one of the longest expansions in the post-war period, which is what the chart on the left there shows. It will be, fast forward to the end of our cyclical horizon. We're not big believers that expansions have to die of old age. Witness some economies like Australia's that have grown continuously for decades, but without a recession. But it does mean that there's some vulnerabilities which typically creep into the system. And so that's what we wanted to spend some time exploring. And obviously it is sort of the end of an era for the US in terms of super accommodative monetary policy, right? I mean, that is, we're well into the normalization process here. The markets are essentially priced for us to get back to a neutral level of what we think is a neutral level of Fed funds, where any moves beyond that will begin to restrict economic activity. So that's well within the next year, within our cyclical time frame. And it's also very likely that we're sort of the end of an era in terms of fiscal expansion. I mean, we're not going to see we've got the fiscal impulse that we know about sort of baked in the cake for the next year. But just beyond that, in our cyclical horizon late in 2019, we know that the withdrawal of that stimulus will create a drag on economic growth too. So it could be happening at the same time when monetary policy has moved into restrictive territory. And of course, that's typically what spells sort of the end of the expansion for the US.
All right, and Joachim, do you want to take the other side and suggest that the question should be answered that this is the end of low productivity growth?
Well, that's clearly a key question for the medium term, but maybe also for this year. I mean, as we can see in the chart, we've had a very significant downturn in productivity growth over the last 10 years. As the chart shows, only slightly above 1% output per hour worked, which is the productivity we're talking about here, over the past 10-year period. Actually, if you only look at the last 5 years, productivity growth has been even lower, only 0.5% on average per year. So you could make a case for some mean reversion. In fact, over the past year, productivity has picked up a little bit. So it's now back to this 10-year average, running slightly above 1%. And we may well see that all the innovation that we have seen over the past decade, particularly new technologies and digitalization, could lead to a takeoff of productivity growth over the next few years. Having said that, so far we're not really seeing one of the key ingredients that I think we need to see for stronger productivity, which is stronger CapEx, stronger business investment. That hasn't happened yet. There are some hopes that the tax cuts that we're getting in the US, the corporate tax reform, will lead to higher business investment. Now it's early days, but what we're seeing so far is that most of those tax cuts seem to end up in either share buybacks or higher dividends or M&A activity, but not really investment in new capex. That's why we're still a little bit skeptical that productivity will really pick up in a meaningful way.